Hello, Warriors. Hiya, Simon. Thanks for checking in on me. Nice to know that, people worry about me. Anyway, just had a lot of rain, no flooding at my house. Okay. Hiya, Sinatra. How are you, George? Look forward to talking to you in about 30 minutes. Hi, Michael. Kman, Bran. Okay. Thanks, Ryan.
No worries,
All
mate.
right. Okay. So, Ryan, you've been trading like an ace lately.
I have.
I bet you're still long the euro. You have so much discipline.
Yep, still long it.
Okay. And
It
getting a
was.
decent bounce in Aussie. And I don't know if you got short yen yesterday, but I know you're looking for that. And then, you know, you must have about 90 handles, 80 handles in the S&Ps here.
Yep, nearly 90.
All right.
8.8 away from 90 handles.
All right. So, I don't know who wouldn't want to be in the room with you all the time. And a lot of these you just, told our free community. So hope there were people out there able to coattail Ryan's excellent trading and patience. Probably easier to imitate, just take a trade than to learn how to be as patient as him. So that's something that's, you're just going to have to work on. I still am. So anyway, weaker dollar. Ryan, comments on this?
Yeah, well, it's a bit of a
Yeah,
funny one right now. We've got dollar yen weakening, but we've also got cable weakening.
yeah.
Euro remains bid against the dollar. Dollar CAD's rising, but oil's going up. I don't know what's going on right this minute. It's all a bit mixed as to what's driving what. The long and short is cable. We had that move up on the data this morning. The PMI is doing better again than in Europe. We've hit near the top of the range, and
Okay.
much as we've seen when we got to the bottom of the range, it doesn't last, and we revert back to the medium, if you like, right, sort of the average that you've got on the moving average you got right in the middle there. So
Yeah.
it's the same old story. You get data, if it's good or bad, you get a decent move, and then it peters out and goes back into the range. So good trading opportunities if you can catch them, but no game changes at the moment.
So this is most likely the trend line. I think maybe Grugga showed it too. That if we break out, we're going, I don't know, 129, 130. But here we are. I actually
Yeah,
took a shot at, I'm not as patient as came in. Looked to me earlier on that EG might be trying to turn here. We'll see. Decent candle. It's got to stay positive during this 4 hour period and do
yeah.
something good to the upside. So anyway, it's just a bottom pick, and I know Blake will say I have smelly fingers, but I also want to say this about the silver. When I was talking 19 as a possibility, it was thinking that this was going to be a breakdown, and
Yeah,
that didn't happen. Okay, they negated it yesterday after closing bad. Sure was a tough buy Monday at the close. Um, Acting pretty good. I don't believe that it's the bottom yet, but just that one day when silver was down 50 cents and they couldn't take anything out of the miners, gave me pause. I
yeah,
didn't do much about it. I did nothing about it really. So the miners are coming back a bit. So, you have, but I mean, it's no trip to Hollywood, called higher, but this could be putting in a higher low here. These are the junior silver miners ETF. Anyway, I'm kind of lost in the dollar as well. I still think there's a shot for 104 and a half, but what are we going to do? Trade 102 first and then put on a leg like this from down here? Uh, that looks possible.
Yeah, well, your 103 looks important right here now, doesn't it? That prior low.
Yeah, yeah.
I don't like it when we come back to a level we've tested really quickly. So we tested it first, strong bounce, and then we've come back pretty quickly. That would indicate that perhaps we're going to have a little break up in euro dollar through this 109, 109.10 area if that 103 goes, because it'll probably be driven by the euro dollar more than
Kind of
anything.
surprised how Canada's holding up with a weak dollar today. Only
Yeah.
down 8.
Yeah, and with oil ticking up, BOC we've obviously got coming up, so maybe there's a few feet taken off some pedals for that one. Just keep an eye on this dollar yen. It's 147.10 and testing that big 147 area.
Yeah, that was
that could be fireworks if
the night of BOJ, right?
Yeah.
So
again,
this
we're
would
back here
measure,
quickly.
could probably measure down to about 5.5 or so if we take this out, right?
Could do, yeah.
Okay.
Yeah.
Our yields weaker, they lower. See, yeah,
just a tad.
10, yeah, down a couple bips. Maybe this was it. Got to 38,420 and turning back down. Joseph Wings thinks that the Fed's going to be aggressively dovish. I got a piece from him the other day. So maybe that was it. It didn't even get to 38.2, 424.
Yeah.
So, yeah, so that's a pretty weak rally if that's all it had in it, as far as, rates beginning to move again. Let's bring Kman in and see what he's thinking.
Hi, everybody.
Good morning to you, buddy.
Hey, how are you?
Good. What are you thinking here? Dollar breakdown?
Yeah, well, I think I said it on Face as well, but I wrote a couple of things in yesterday's chat room too, thinking that the repricing is probably for the bird done. So I got quite cautious on the dollar. I actually bought cable yesterday. Bought a couple of Aussies this morning, hedged more of my dollar Swiss call yesterday afternoon as well. So I'm a little short dollars, long S&P. Yeah, that's about it. But
Silver?
a lot can change again in an hour and a half time on the PMIs. We're still in those ranges, but it does appear to me, and also when I look at differentials, that the dollar may have done the major correction in the new year, and
Right.
now we're looking at for something else. What's next move now?
Yeah. What about silver? Do you think that was enough at 22?
Well,
Did you add on down there? I didn't.
It went twice below and twice rejected. Now we're back above 22.5. If you look at it from June, July, we're still in that yo-yo, right? But yeah, I mean, it's a bit in line with the rest of the dollars, right? We had the big dollar bounce the first 2-3 weeks of the year, and it seems to wane now as well. So yeah, the metals are coming up too. And yeah, those yields, if the FOMC is very dovish next week, of course it's going to hurt those yields, and probably the dollar as well, send the S&P another leg, or stock markets another leg higher. But it's also a bit of a catch up perhaps on what was happening on those equity markets, because the dollar didn't weaken for the first 150 or so points of the rally in the S&P. The dollar didn't weaken, and now it's catching up a little bit. And I think that has to do with probably people needing a few dollars to go to the treasury issuances, and there's still a few coming later today, and another one tomorrow. But perhaps they just have enough dollars to go to auction. So I'm a bit cautious on the dollar here. I'm not majorly short, but I'm just in a few currencies.
I mean, wouldn't it be possible for the dollar, that this was A and we get a pullback for B?
Absolutely.
Down to around 2 and then do this again to up here?
Absolutely. And if it was happening
That's the way it's starting to look to me after today. It started to feel like that a little bit yesterday, but for sure today.
Yeah, you know what? I think ECB tomorrow, and we already know from Lagarde, if she says anything different than what she said in Davos, it would be a very big surprise. Although we had those weaker PMIs, but I think the FOMC. Powell said what he wanted to say in December. I'm not even sure that FOMC this month is that relevant.
And USD MEX, okay, we got down to your levels after the first pop. You said you were looking for, 1710. We got to 1705. Why don't you clean it up and call the exact number next time?
Okay.
So how now, brown cows? Have we rallied back to daily moving average? What do you think?
Yeah, you know what I told you on the first pop in the dollar mix, right? That some in the market were trading the Trump victory in Iowa. And now, a week later, since he won again in New Hampshire, now everybody is saying, "Oh, the mix is on the defensive because of the Trump trade." And well, I think the real trade was last week. I'm not sure if there's much more to trade on the back of it now, until we find like a very clear thing that he's going to beat Biden by a mile, and even if he can run. No, but I think we are going to continue to yo-yo this, and yeah, 17 is probably a good bottom right now, and 1740 is 1735.40 a good top, and I see it more in a range.
Okay, it's going to look pretty good over 1740 now.
If it goes up there, then I think
Yeah.
we're going to need to run.
Because I mean, this is a higher low with what the dollar did and everything. So maybe we're setting up for something like this
Could be
from here.
Could be, and I think Mexico is next week, if I'm correct, and people are starting to think they may go more on the dovish side as well. Oh no, they are not before the 8th of February, so there's still 2 weeks to wait. But yeah, a lot of people think that LATAM and other EMs will start, high yielders will start to cut rates soon.
Okay, gold silver ratio pulling back as well. We'll see if it negates a breakout here. So maybe this was just a shakeout move. I look at it on the weekly, and it's putting in a tail. Now it's a reversal week to the downside. So maybe that was it. And silver did, that's good news for silver, especially if we get back under 87.60. So keep an eye on that. Sure shook a lot of people out after breaking out, but only had like 1 or 2 good days after that. So keep an eye on the breakout, looking for a breakout failure if it gets there. Blake, what are you up to this morning?
Trying to find my unmute button. Good morning.
Hey, good morning. How are you?
Good. Just, watching all this, well, first of all, we had, China's, cut the PBOC cut rates by, or they are cutting rates by, is it lending rates by 50 basis points? Is that correct?
The RRR, the big one.
The RRR. And that was, so that goes into effect next month, and the markets loved it. I mean, look at copper, look at, Chinese markets. I was just talking to Chris Weston last night about, money going out of money coming in China, out of Japan. So you're seeing the Nikkei pull back. We saw the big divergence a couple of days ago. I think I tweeted about it. Dollar yen is, back at 147. This is really critical support. The dollar is actually just flirting with really key support ahead of the PMIs today. So we had Eurozone PMIs, UK PMIs that came out, and I mean, those were all better. And I'm still very surprised the cable couldn't get above 127.80. It's like just like this huge range resistance, and we rejected really hard. What do you guys suspect is the reason for that? Because I didn't expect such a big rejection of that level.
Just it's the same old, same old. You know, we've come through central banks, inflation data. You know, we had a huge data week last week in the pound, couldn't break the range. There's no real reason for a PMI data today to break the range. It confirms that the UK is doing better than Europe still at the moment. So, you know, you still got a bid in the pound versus the euro. But cable, 126, 128, wake me up when we break either side.
Yeah, I mean, you know, this is like if you just, you know, have been reading like the analysis from last week, the 126 to 127.80 range has been the range to play, and we basically hit the top of that range today, and we just can't break it. Also, I guess one of the other things I want to point out is the euro is back at the 109.10. It's a level that I mentioned on the week ahead video. I talked about, you know, we've talked about it all like last week. It's just a really key level of resistance, and it just coincides with the neckline of the dollar index. So I'm going to just put it to you real simply. Today's PMI data really matters. I mean, it matters for the dollar, because if the dollar is going to hold these levels, we have to see an improvement in the PMIs. And if we don't, the dollar is at risk of a pullback. And I know you've been harping about it too, Ryan. And I just closed out my dollar yen this morning because we're back at the 147 level. And I mean, I basically, after, you know, carrying it for the last week and a half, my, you know, 20 pips of 25 pips or whatever it was of gain is basically in the interest. So in the carry fees, but we're basically at really key support. And the dollar looks vulnerable. If we have weak PMI data today, and, you know, coupled with stronger UK data, stronger Eurozone PMIs for the most part, the dollar is at risk of pulling back. And I think the dollar yen could see a nice little vacuum here between 147 and probably back to 145.
Hey, Blake,
but, that's go ahead.
Yesterday you brought up the fund that went out of business from being short Nikkei and long China. What a buy signal that was for their trade.
That wasn't me.
Yeah, it was some fund that was they're closed. Do you remember, Ryan?
There's another one today, Cube or something, a fund that's short, taking a $1 billion short on German stocks, a lot of the automakers.
Oh God, really?
Yeah.
Wow.
Well, we've got one of Gav's trades, one of our mate in the room. Every time there's a big trade like that, it's one of Gav's trades.
Yeah, I mean that's gnarly. You know, and I want to talk. You know, since we're talking equities, let's just, you know, take a real quick look around, because I think it's important. I want to show you guys something specific. So here's China. Obviously, we're seeing that reversal in the China 50. Hang Seng showing, you know, maybe a double bottom here, and then you can also see how the Nikkei is rolling over. Now, you know, we've had this 161% extension, divergent relative strength, and that's obviously giving the yen some strength as a result. Now, take a look, just before you guys get all hot and bothered about stocks. I do want to say that the S&P is within literally was that 20 points of 161% extension and completing an equal leg move. So, you know, I know it's exciting, you know, to look at the stock market and say we're in breakout territory, which we are. I'm not going to deny that, but I do want to say that we're up against really key levels. This is those key levels where, you know, if you're not looking at it and all of a sudden we get a reversal and you go, well, you know, a week later and go, why did that happen? And why did we, you know, get some sort of false breakout or something above the highs? We're at just such critical levels. I'd like to see a sustained break above, you know, the 4,900 to be really comfortable. And you know, the dollar's confirming that there might be that move. I mean, we are seeing some pretty strong dollar weakness at this point, which, you know, would complement move higher in equities at this moment. So anyway, a lot of big dollar moves today overnight, and I think this dollar yen is definitely threatening. I want to not only talk about the dollar yen though, and then I want to come in and get some thoughts from Ryan and Kman about some of these ideas. You got the euro yen that really has struggled at the 78% retracement. I'm just going to pull up some of the yen pairs here so you guys can see them. The pound yen stopped right at resistance. All right, and it's reversed since then. You have the Aussie yen, right? Triangle resistance held. You got New Zealand yen trying to forge out a lower high. It is. And then, you got your Canadian yen, which is also up against really, really critical resistance, and it is rejecting. So all of these yen pairs are really showing a big reversal here from key levels. So it's not just the dollar yen. It's all of these yen pairs. You can see them just all starting to roll over. And that means that the yen strength is going to be more of a yen move when you see, markets move money. Like, I was on the trade-off show with Chris Weston last night. And what I said on the trade-off show was, this is a very one-sided move against China. You got to be careful being short. And he's like, yeah, well, if China starts to reverse, which it has overnight, you're going to start to see, the weakness in the Nikkei, because it's been a buy Nikkei, sell, China. Well, if China is reversing, and I read some reports from, or I read some analysis from Mark Chandler this morning that also suggests that the PBOC is calling around at different funds, trying to get them to stop shorting the Chinese markets. You get a reversal in flows, you're going to see a reversal. It could lead to not only Japanese markets rolling over, but also other markets like the German DAX and potentially here in the US. So just keep that in mind, because it's been really one-sided. When the market gets really one-sided like that, it tends to send ripples through other markets as well when you see reversals. So I think that's going to be the bigger risk afoot, and I think it's something that we need to keep in mind. Anyway, one other thing I wanted to point out: gold. Gold is at channel resistance, and this matters because a weak PMI data today would send gold reeling back to 2070, and it's going to send the dollar, under pressure. So just keep that in mind, as gold is threatening to break higher if the dollar continues to weaken. So I know we covered a lot already this morning, but Dale, you asked me what I'm thinking, and there's a lot going on today. So Ryan, what are your thoughts here as we go into we have the Bank of Canada. We haven't even talked about the BOC today. I'm looking at 134 as being really critical support for the BOC, or I shouldn't say the BOC, for the Canadian currency, for the dollar CAD. I think that 134.06 is big. It's a huge pivot. You can see it's a big dotted line. Are you expecting anything out of the BOC today?
No, I'm not. They could be a bit more hawkish on the higher inflation numbers. They could be a bit less hawkish on the retail sales and jobs numbers that we got recently. So it should be middle of the road. I can't see any big moves coming from this one. I'm setting my fishing rods out a little bit wider, 133.5, 138, high 138 to 136. You can fish that pond around 134, and good luck to you. Yeah. Reminder that he's 15 minutes earlier than normal.
I might get a hook in my cheek if I do that, but we'll see. Maybe not. It is the 38% retracement. I do believe it's a pretty key pivot. But yeah, the Bank of Canada. First of all, I'm going to just say this: I want to be short Canadian dollars into this year. Whether it's into the dollar CAD being long, or the euro CAD, or the sterling CAD. I don't know, CAD yen. I would be short that, even though I'm not short that. I would be short that. It's I want to play the Canadian dollar on the short side. I'm just trying to figure out which way I want to do it. But anyway, thanks for your thoughts there. Kman, we do have the Bank of Canada today. What are you sensing with a lot of these flows that we've been seeing globally and this reversal in China? What's it speaking to you?
Yeah, well, to be honest, and I said it on the Flow Show, I think I have absolutely no clue on the Bank of Canada. They could hide behind inflation a little bit higher than but that was everywhere the same in December. And the rest, I really have no idea. Just watching those levels, same as everybody, 134, 135.40. The China, whatever analysts or so may say about it, people should listen to what I said yesterday on F.A.C.E, because I said that when you see the news come out of all those things, the BOA guys getting laid off, who played it wrongly, that fund played it wrongly. What we saw over the past week is probably them getting out of their position. So I think it's relatively logic what we've seen here. But it's true that China is actually now trying to make work of things, and it may be that it just may be that we have seen the bottom now that all those guys are out of it.
Yeah, look at copper respond.
Yep.
That's a huge move. Huge. I mean, it's up 2% today. Yeah, I look around at China and it's like I would not want to be short. Not, big green bars are usually followed by other big green bars. I mean, that's just a kind of a rule of thumb in the market. So that's a big green bar coming through the market right now. But things could obviously unwind. By the end of the day, we still have, or here in the U.S. And speaking of the U.S., let's talk a little bit about this. Dale, we're literally, we start getting above 4,900, and these levels. We could start really talking about, blow off top territory, where the markets just start accelerating. There's one of the scary things, and I was telling Chris Weston this on his Australian show last night. I've seen in my 25 years of trading, 27 years of trading, or whatever it is, I've probably seen a handful of blow off tops or capitulated moves. Crude oil at 150, dollar CAD at whenever it was at 88 cents or whatever it was. Stock markets in a couple of different capitulation, S&P 666. Those are all generational levels. I am scared as somebody that's looking 10 to 15 years away from retirement, to hanging up my trading boots, that type of thing. I'm a little worried when I start looking at stocks and thinking about blow off tops, because if we get like an accelerated move to, let's say, like 5,500 like in the next week or two, when you start propelling 7-8% higher intraday, and then get a reversal like that, when you see moves like this intraday, they go up and then they come right back down. Those are usually blow off tops. And like I said, I've seen just a few of them in my quarter century plus of years of trading. It is scary because I don't want to see a blow off top in the stock market, because if we do get one, that means that top's probably in for quite some time. And Dale, it looks like it, doesn't it?
So you won't. So don't retire.
Yeah, I'll be like 90. I'll be sitting there going, all right.
That's my return. That's
Dale and I will still be here.
And
Ryan,
Ryan and
Kman and I, we have our retirement plan, slumping over on the keyboard.
By the way, dollar yen is taking out the 147 level. Just FYI, so we'll
are die with our boots on, man.
Anyway, it's stocks do look very, 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 very bullish, and I know we have some upside targets here that we need to be watching. But man, I was
approaching Jimmy's, right? 49 something.
Jimmy's.
Jimmy Welsh.
Oh yeah, 4,900 would be the and he just threw that number out like for a fifth wave or something like that.
Yeah.
And I put some technical levels behind it. It's just it's a equal leg completion and 161% extension. So it all makes a lot of sense, getting up here. But we do have some big data today. We have PMIs. Don't forget that we're also in earnings season. We got Tesla after the close today, which is going to be a big one. We have IBM, and remember, the semiconductor index has been leading the equity markets higher. So with that happening, a lot of these big semiconductor companies like IBM, I think Intel's tomorrow, they're going to be in the spotlight because they have been leading the market higher. So anyway, a lot of things happening. I know you have an interview right now, but I want to say, guys and gals, if you want to take advantage of this volatility that we're seeing in the markets, check out the Trader Funding Program. If you want to learn how to access larger amounts of capital, you can do it right here. And make sure you take advantage of being in the ForexAnalytix community, so you can chat with Ryan, Kman, myself, and so many other traders in our community throughout the course of the day, posting our trades, talking about putting in all the big research that's come across throughout the night. Here's our chat room. You can see like our general chat room, some charts around the room, where we're buying and where we're selling certain positions. You can see it. Here's my open positions and what I'm closing out. S&P room, lots of communication around here. So make sure you jump in our community. All right. With that being said, thanks, guys. I'm going to pass it off to Dale. Kman, Ryan, thanks for getting us up to speed today.
Ryan, how do I get into your hedge fund?
Oh, I don't know, mate. You got any chocolates or cake you can bring along? You can get straight in, mate.
Nice work, buddy. Okay.
Thanks, mate.
Thank you, Blake. Blake, you did.
Look up for hammers.com.
All right, and Blake, you laid out a lot of real important things happening. Today's important. We always say today's a critical day. Today is.
It's a big one today. Thanks, Dale. Yeah. All right, I'm going to pass it to you. Have a great interview.
Pay attention to George Robertson. He knows about the bond market and the Fed. In fact, I was just going through your stream, George. Welcome back to F.A.C.E. Happy New Year.
Yeah, Happy New Year to you guys. Thank you. Thank you for having me.
Oh, wow. Looks like a little purple haze happening on the screen.
I can't help it. I just don't have the video, so
all right, it's
put
okay.
Up with the Zoom background, and I just rolled out of bed sweatshirt.
All right. What's your sweatshirt say?
That's the I'm proud to say, I'm glad you asked. That's the USS Bruins. One of my kids served as an officer on that.
Oh, okay. Congratulations. Yeah, good to be a proud dad.
All hers, not me.
Yeah. Okay. So, George, I went to your stream, and a lot of people are talking about what the Fed's going to do next month, and they're talking about the Taylor rule, and you actually have a little derivation of that. So the Taylor rule has become the Yellen rule. So
that's right.
Can you explain to our audience?
Yeah, sure. When the Fed and the administration had a problem with the lackluster low growth that we experienced ever since, say, 2013 or so, they had to monkey with the Taylor rule. Otherwise, the Taylor rule was always showing results for Fed funds that were impossible for the Fed to apply. So they replaced the CBO trend growth potential with various rules. There's about 3 or 4 rules, which is like double the employment growth, or this or that. And Yellen actually tried to claim some of this. I can't remember exactly what her formula was, but she called it the Yellen rule. The Atlanta Fed has a very popular utility. It's worthwhile looking at. It's the Atlanta Fed Taylor rule utility. And as you fill in the numbers to figure out where you think the Taylor rule is, it gives you like 10 choices to figure out the growth and about 5 choices to figure out what the inflation to use, and then whatever coefficient you want to apply. And it seems people are going in.
And is this how the Fed really derives their decisions, by
I think
having
actually right now they gave up on the Taylor rule a long time ago. This is all marketing and propaganda. And it's interesting to see how some, I would call it, although it's a very respected hedge fund / PE guy, comes up with his own bias of what he thinks the Taylor rule should be to confirm that the Fed is going to ease. That they use this uncritically, without the study and the great amount of criticism and presentation of the original Taylor rule. It's just slapdash. So that's making the rounds today, and it's just another marker of how flaky and how out to lunch the community has gotten in terms of understanding the Fed, and also the Fed's relationship to inflation and the economy.
What do you think they're going to do next month, George?
I'm gonna actually be a pain in the ass, Dale, and I say it doesn't matter.
Okay,
it'll matter in terms of sentiment and people getting excited and running around back and forth on the sides of the boat, but it doesn't matter in terms of the U.S. economy, nor inflation, nor issuance of debt, nor anything that really does matter.
It matters to the dollar, and I think the dollar matters.
Only in terms of sentiment. And now that's sort of an aloof way for me to be able to jam market reality into my belief. But I think my belief is based on pretty pragmatic, normal cause. And I'll have to suffer the month or two as people get overexcited about the Fed. And then they're going to come back, just as they have for the last 3 years, to the reality of the U.S. economy.
Okay, so this might be setting up more rally and risk as people remain euphoric if they do it. But then reality starts to set in a few months down the road. Are you kind of looking at this spring as an inflection point, because perhaps inflation might start to heat up again?
Well, it seems my success in markets is I have to dive for cover and say I work in an 18-month cycle. Sooner or later, one of the market moves will justify everything I said. If you remember the last time I was with you, pretty well everything I said then came about. Now, of course, when I said it, it sure hell didn't look like it was going to happen. But I'm going to say that, damn it, I had the foresight and the knowledge, and it did come about just as I said pretty well. Okay. All I can offer you, and I really get a kick out of listening to your peer group, is that I could just give you a really fundamentalist, sort of like pounded into me over 20, 30 years of working on Wall Street in fixed income, idea of what is actually going on. And it is clearly being dwarfed or swept away for long periods of time by sentiment and the way the market's trading, and also the big Fed propaganda machine.
Is this a sentiment rally here in the bond market?
I think that until equity gets to, here we go, I'm making my 18-month call.
Okay.
Until equity gets to like 30, 40% up from where it is now, and it won't be a blow off, it won't be a capitulation, although it probably is more profitable to trade it with that mentality. It will be because that the sentiment, the meme, the Fed propaganda machine is giving up on trying to jam risky assets into their presentation of what's going on with the U.S. economy and, of course, the Fed. Right now, since after the top of 2021, the Fed has been just jamming everything they can into saying, like, you're going to get it and get it good. I'm going to raise rates. It's going to be bad. Unemployment's going to go to the moon, blah, 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 blah. And there hasn't been one data point that has shown either the presence of that policy or affirming that the policy is working. It actually, every data point we've had since Jan 22 has been to show that there is no Fed. So that's why I cheekily say I don't really care what the Fed does, but I would really care if you were to hand me X amount and say, go make money in like Canada or the euro. I would quickly probably shed everything I just said and just say, I want to stay alive. And so I will trade the technicals rather than the fundamentals. I cheerfully admit that the fundamentals are probably if you're investing your 401k for the long run, if your whole way of life is going to survive, if like the endowment of such and such of multi-billion dollars, you should listen to the fundamentals. In the end, that is what will make or break you. Okay. But in the interim, I don't know if that's going to be very effective in terms of like the next week or two.
Okay, so I look at this and I wanted to have kind of a visual understanding of what some of the bulls are talking about, George. And
sure,
you know, this is back to the 21 high, and then we stalled up there a little bit. If you consider this a breakout and this whole range here, it measures 6,100 S&Ps. Is that within what you're talking about? Like we have a orderly trend move to the upside towards 6,000?
I think what you're showing here for 2022 is the full force and fury of the Fed to try to contain the stock market.
Yeah, this and and that was it. And they were still raising rates, and the market started to smell that it wasn't working.
It was bullshit. If you look back at 21,
get right to the point, George.
Yeah, if you look at 2021. I don't think the Fed's going to hire me anytime soon anyway, so I can say this stuff. But if you look at 2021 after COVID, that market pattern is probably, from my point of view, more in sync with the economic reality that was presented to the market, not by the Fed or by trends or anything, but was presented by just like, we are going to jam like making a goose liver ready for foie gras. $3.5 trillion in perhaps the shortest span of time of one of the largest numbers since World War II.
Yeah.
And that's what happened. And then thereafter is the attempt of the Fed
to drain
and other interested parties like Jamie Dimon in January of 2022, saying that, wow, if this really reflects what's happening with the Congress and the fiscal policy, then boy, it's going to get weird quick. And it could get into such a force that J.P. Morgan's basis is threatened and so on.
He had war rooms set up.
Right. So therefore, I think what you're seeing there in terms of this choppy, finally getting back up to the highs of 2021 is what the power and the ability of the Fed is to try to cap that. They do not want to get into a Greenspan exuberance type of situation.
Then why did he turn into Arthur Burns at the last meeting, taking victory laps?
I think he's in trouble. I don't think Powell's a dummy. I think he's a bureaucrat par excellence. He got turfed out of Carlisle because he wasn't allowed to get to the main table. But he's a good fella. He seems very, very bright. He's a great administrator, great bureaucrat, and you would think he would make a good Fed chair, but he's been all loose and cowardly almost in terms of how Trump backed him down in 2018.
Yeah,
and he's been very responsive to the political.
Who backed him down this time, George? I mean, a lot of people make it political and say, they're Democrats. He's starting to ease to help Biden get reelected. Do you buy any of that?
100%. I think,
do? All right.
I think you said Burns, which is appropriate. Burns' relationship to Nixon. I don't think it has anything to do with party or a conservative or liberal stance. It's got to do with this guy wants to get reappointed probably for another 6-year term in a couple of years. And he also wants a legacy. He does not want to be a Burns. He does not want you to say he sounds like Burns or Miller.
He's got a legacy already.
Yeah, it's as a failure from my point of view.
Right.
And
like most, eventually, even the Maestro years later was called a failure.
That's it. Volcker is Volcker's free game now to throw bricks at.
Yeah, he's the last one left. He's the only godlike figure from the Fed.
Exactly. I think the problem is that the Fed has bitten the apple. It has gotten into a persona, a reputation of like way more important, way more powerful, and way more effective than it ever was meant to by law or by reality. And they're now eating it. A lot of this goes back to 2012, 13, where when they hit rates at zero, they couldn't follow the rates down to negative as per Taylor rule or other understandings of monetary economics. So they had to come up with all sorts of bullshit about like, well, zero is pretty good because we're going to do QE and QT and all sorts of propaganda, basically what it is. And then once rates actually got off zero, because the economy did start to grow, a lot of it from the shock of Trump's corporate tax cuts and also with, of course, COVID, they had already adopted a policy to paint things with all this crap with ZIRP and zero lower bounds, which is called Neo-Wicksell Woodford. Now people get, what the hell? Why would I, if I'm just trying to survive in Forex for the next week, ever want to know anything about it? But I think it's important to really understanding and come to your own opinion about what Neo-Wicksell means. Woodford, this is the 2012 paper that Woodford presented at Jackson Hole. And the vast change in the whole Fed's way of operating, ways and means, and the reliance on nothing but propaganda afterwards.
You need to write a book, George, or have a course,
What I just said, Dale, ain't making me much money. So anyway, I'm having fun. Right? Okay.
All right. Okay. It's not always about money.
It's not always about money. I thought maybe it should be. And the risk manager in my house, my partner, is very askance at me babbling away about all this stuff. She's, where's the money? Okay, what can I say?
Show me the money.
Show me the money. But I have some schemes and things that I've done over the last 30, 40 years that at least allow me to operate. And this is not my house's background, by the way. This is just something I choose.
Yeah.
Anyway, what I'm getting at is that everyone should be aware that as long as the propaganda and the bullshit that the Fed is putting out, in which almost everyone's adopted wholesale, like this is reality, is aware that it ain't, that it is almost getting to a falsehood. Every time Powell goes in front of Congress, he's perjuring himself now. I don't even think he believes in this stuff anymore. But carry on, because there's certainly more of the characters who think I'm out to lunch and just a mad old guy versus anything that can be used week to week. So we're going to trade the propaganda and the setting of the Fed. But you should be always aware that there's probably a 20% change in a lot of stuff once this is disclosed. Once everyone realizes that the Fed's an empty suit, we're going to have massive cuss moves in the market, both up and down, and it will happen well, we've seen these things in the past when this type of correction.
This year, George. This year,
pardon?
Could it be this year?
I don't think so. I don't think this year, because Trump's got to get elected, and a lot of congressmen got to ride on Trump or at least hold the line so that they can go to as opposition. There's a lot of money that's been taken from crypto lobbies and this and that. So Congress is, who am I to say they're corrupt? But anyway,
who's going to be the next Fed chair? I
think it's Brainerd. I think Brainerd's
if it's Brainerd, it means it's not a Trump victory,
right? But it could be Brainerd in terms of maybe Biden does something sooner for the election, but that's okay. Unlikely. This is what I'm saying, is that it's unlikely this year. Okay. And there's a thought that it might not take place next year, or at least half of it. This is a great romantic setting for, Trump gains victory, and then he sits on one of the biggest debacles in U.S. financial history. There's a lot of people who think that's very sweet, but it is the setting is there. There is no Fed that's effective. The fiscal is out of control, and it's got nothing to do with, like, I hate deficits, they're bad, how are we going to pay for this?
It has nothing to do with political parties. It just comes down to when the plug is pulled.
Exactly.
When the con is exposed in confidence.
Say it ain't so, Joe. You know, it's just like, say it ain't so. And yeah, I did rig the World Series. There is going to be this realization. Now, there's a chance that the Fed might ease back to reality through subterfuge and gradualism, but I don't think so. I think they've gone too far off the rails. Okay, so anyway, there's I think I've said some dramatic stuff, which might be of interest, but I can't be held to anything that happens.
How do you invest in an environment like that? You just stay in T-bills?
Yeah, no, as far as investing, yes. Okay, let's say you don't have the option to be short. If I did have the option to be short, I'd be short the U.S. Treasury 10-year, because I think 6% is the results of everything I say. I also think that I don't have much view on international. I have a hard enough time trying to be, somewhat cogent in just the U.S. stuff. I took a play in Boeing, which is just gutting me. It's I see. I mean, but who the hell? I didn't know that the sides of the plane were going to fall apart, and I thought they'd stop crashing into the sea. But anyway, that's my excuse. But I'm getting
this is a big call, because it's very contrarian. Most people think that we got to the terminal rate, and
I think to think
you're saying something else.
Well, to think that the 10-year will trade under 5% when NGDP is likely going to be over 5% for the next couple of years, and inflation, I think, is going to be pretty sticky around 3.5%. That 3.5% will define Fed funds, but it's not going to define the 10-year. And I think the 10-year is going to be based upon the expectations of U.S. GDP growth, which I don't think many people are arguing with the fact that it's probably going to carry on as it is, maybe a little stronger, maybe a little weaker. And that requires a 6% U.S. Treasury rate at some point. It also requires
just based upon supply crowding out, those kind of things.
No, this is where I get even more ornery. U.S. Treasuries are risk-free rate, if I can use that label rather than U.S. Treasuries, because I think they're being very much pressed and modified by where the Fed buys U.S. Treasuries. But if we look at the risk-free rate, that is never dependent upon supply or demand of funding. It's based upon NGDP. Full stop, period. It's the way it has always been, and it's the way it's always going to be. Now, at any one point in time, there can be a lot of buying or selling by the Fed, which can pressure what's called sector segmentation into a mutation of where the curve should be and where the rates are. But the risk-free curve is always with us. And what I've shifted to was that after, since the products were created, there's been a divergence of U.S. mortgage rates, 30-year conventionals, which is usually pegged to the 10-year, altered for, convexity. It's a mortgage versus a note. And if you alternate that, you come to an equivalency with U.S. risk-free and the U.S. Treasury 10-year, which ended last in 2021, 22, in a dramatic way. So this relationship has been upheld for decades and decades and decades. And just since COVID QE, it all went to hell. So I'm just gonna, because I could do it and because I don't have my job dependent on it, I can just dismiss where the U.S. Treasury 10-year is trading and look at only U.S. mortgage rates as an indication of where the risk-free rate is. And if you think about it, U.S. mortgage rates being government-backed in the end, they go into mortgage-backed securities and they're quasi, they are risk-free, basically. If you adjust for that transformation to mortgage-backed securities, and then also get to the equality of a fixed income semi-annual bond structure, the mortgage rate has to respond to the economy. People either buy houses or they don't buy houses. They buy houses because they got more money. They don't buy houses because things suck. So the U.S. mortgage rate is always a fair rate, an efficient rate, a rate that actually discloses where the U.S. status is in terms of economic growth or decline. And so it is the real, reals, I don't want to say real GDP, that's wrong, but it is the risk-free rate of the United States right now. And that spread between that has grown like it used to be like 130 basis points, 1.3% into 21. That thing is just blown out to 3%, which is something it hasn't done ever since mortgage-backed securities were created in the 80s. So something's going on. That's my explanation. But I think everyone should give pause to that before they come up with an idea that U.S. Treasury 10-year has something to do with something with the U.S. GDP. It doesn't. And if it does, it should be at least 5.5 now. On the basis of what I just explained, it actually touched 6%. So adjusted in 20 in quarter 3 last year, before all the quarterly refunding announcement hoopla. And there we are.
Okay. So here's George's X handle. And looks like you have a Substack little column here, right?
Yeah, I have 2 causes for that. The first thing is that I got to please the risk manager at home and try to figure out some way to make some money. And also, I have a guy who thinks I'm adequate for his partnership. He's 5 times brighter than me, and a Duke Folk scholarship type guy, young fella named Riddick Goyle, which is also worth a follow too. At RP Goyle _. So I got to figure out how to make some money on this stuff rather than just have fun and play and talk stuff.
Okay, well, I want to wish you good luck on that and everything else in 2024, George.
Okay, and
you really, you really are an academic in the bond market. Really, I haven't heard this kind of stuff from a lot of people that say they're fixed income people before. So, thanks for edifying our community today.
Well, Dale, I'm going to assume that's a compliment, not a head shake. Anyway, just like you did last time, I'm all set to come back at whatever time period you want to either eat crow or to revel in my brilliance.
All right. Well, this spring we'll see what's on the menu.
Okay, sir. Thanks for the time. It's a big compliment.
All right, George.
All right.
All right.
Bye-bye.
George Robertson, everybody. Hope you enjoyed him. Check him out there at his website and see what his writings do for your insight into the Fed. And that's a wrap for me. In 17 minutes, you have the team on the morning edge. Don't just count your coupons, count your blessings. Right, guys? Bicker and brattle. You're welcome. Adios. Yeah, see you tomorrow. You're very welcome.